Hi, this is Russ Squire again from 1031 Property Exchange, and we're going to continue the course of using 1031 exchanges to grow your real estate wealth. I'm going to talk about some exchange rules and some other topics here that I think will be very interesting, so we will move it along. First, understanding the property investment decision, and this would be reinvestment. One, higher returns mean higher risk. And that's a rule of investing that extends across all assets, whether it's stocks, bonds, or real estate. Two, diversification by type of property owned and region of the country that it is owned is important. Three, national tenants with a strong credit history, great location, and a long-term lease always make the best tenants. Four, don't get tempted into stretching for yield or concentrating too many assets to any one property type or region of the country. These are avoidable mistakes, and it's called diversification. So, what types of property can you invest in a 1031 exchange? Well, shopping centers, multifamily apartment complexes, big box commercial stores, strip malls, industrial, office buildings, retail stores, storage facilities, you name it. Where to invest? Well, you can invest anywhere here, any of these 50 states. So you've got all sorts of decisions to consider, and familiarity oftentimes is an important part of that decision-making criteria. We understand that, so sometimes people like to have things that are close where they can drive by, go see it, touch it, whatever the case may be. You have to decide what your personality is predisposed to. 12 exchange rules and topics. You have to use a qualified intermediary. You must use a qualified escrow account. These are exchange safe harbors. You have to follow the like-kind requirement for replacement property. The language needed in the buy-sell agreement is an important aspect. Proper documentation of the exchange, the holding requirement, ownership and registration rules, 1031 time requirements are important to understand and also to meet. The property identification rules are another important part of the exchange. We'll also go over what constitutes booting an exchange, the total exchange period, and then how to select a qualified intermediary. So you have to use a qualified intermediary. And what does qualified mean? Well, you have to use an independent, unrelated party in all delayed and simultaneous exchanges. And that's per IRC regulations 1031, and it gives you the sections there. Qualified intermediary is a middleman and a safe harbor in the IRS regulations. Types of qualified intermediaries, well, there are limited service ones that just do the documents and act as escrow, but they won't advise you on the technical aspects of an exchange. And then there are full service ones like 1031 Property Exchange that does do exchanges full-time. We act as an escrow, we complete the necessary documents, and we advise you on the technical aspects of your exchange. Who can't be your qualified intermediary? Well, the exchanger's accountant, attorney, financial advisor, realtor, or any relative. Now, a lot of title companies have gotten into exchanges. I don't think that should be allowed because there's still a party who's providing you with a service, however it is. So that is what it is. You must use a qualified escrow account in exchange. So with the exception of simultaneous exchanges, meaning two pieces of property swapped at the same time on the same day, all other exchanges require a qualified escrow account, and that's a safe harbor under the IRS regulations. The exchanger must not have the ability to receive any exchange dollars during the exchange. If they do, it's constructive receipt, and it creates what's called taxable boot, which we'll go over a little later. The escrow account cannot be pledged as security or collateral during the exchange. If it is pledged, then you, chances are, disqualify the exchange and create a taxable event. The exchange company should have clear written policies that require the exchanger's approval in writing for every escrow disbursement. And that's important, and that certainly is a criteria we use at 1031 Property Exchange. Qualified intermediary and the qualified escrow operate as separate safe harbors. So the qualified intermediary completes the documents that keep the transaction in compliance with the IRC 1031, and the qualified escrow holds the funds during the exchange period and complies with IRC escrow requirements like no constructive receipt. The intermediary can and often will perform the escrow function. Our company does both the intermediary and the escrow function of the exchange. The like-kind property requirement. Like-kind is a very broad category and virtually means any real property for any other type of real property. All below are like-kind. So for instance, you could sell a condominium and buy a townhouse. You could sell an office building and buy an apartment building. You could sell a ranch, buy a single family home. There really aren't a lot of types of real estate that are prevented. It's more their intent. Are they held for business or investment purposes? There's even more to like-kind property. You know, a ground lease is considered like-kind property under 1031. A lease of 30 years or more, like a Forest Service cabin, can be 1031 exchanged. A partial tenant in common interest in real estate, and that's per IRS ruling 73-476. Easements are considered exchangeable in a 1031 exchange. Mineral and water rights are exchangeable, so oil and gas leases, things of that nature. Gold, silver, you know, the commodities of that type are exchangeable. And improvements to be constructed can also be exchanged. And then there are also timeshares. Certain timeshares can also qualify for a 1031 exchange. So, you know, it doesn't just mean real property deeded directly to you. It can mean other types of property as well. What is not like-kind real estate? Well, inventory or property held primarily for sale, meaning a dealer. Corporate stock, as we discussed. Bonds, securities, REITs, mortgages, or notes. A partnership interest is not capable of being like-kind exchanged. Certificates of trust or beneficial interests. Real property for personal property. In other words, you can't sell a piece of real estate and go out and buy a car. Exchanges between certain related parties where one of the exchange properties is subsequently transferred before the end of 2 years, and once again there's that 2-year time holding period. Certain intangible assets like going concern value and goodwill don't qualify for an exchange. So if you're selling a business, you want to get the full value into the contract price. Separating it out and listing goodwill as part of the sale isn't going to do you any good in exchange. In fact, it's going to hurt you. Real property in the U.S. for real property outside the U.S., that's not allowed. Special rules for partnerships. Well, partnership does not qualify, or a partnership interest does not qualify for a Section 1031 exchange, but an entity, the partnership itself, can qualify for an exchange providing all other requirements are met. So if partners want to sell a piece of property, buy another piece of property, and everybody agrees to it, and all the ownership remains the same, they can continue to hold the replacement property as like-kind investment property. But if you have one dissenting partner, that's it. You can't perform an exchange. Language you have to have in a buy-sell agreement to allow an exchange, well, that's the language right there. Most all realtors are familiar with it. We go over every buy-sell agreement for every exchange we perform and make sure this language is there. And if it isn't there, we make sure it gets added and the buyer and the seller sign the paperwork again so that we make sure we've got all the legally qualifying language that's necessary in order to perform an exchange. Language you should avoid in a buy-sell to avoid the taxability of personal property. Well, don't list any items of significant personal interest in the buy-sell agreement or settlement sheets. You can do a parallel rollover of real property for real property because you can exchange real property for real property and personal property for personal property to create a non-taxable event. Now, you can also acquire the personal property separate from the real property in an exchange with funds outside the exchange or outside of closing. These are real, true stories, things I've encountered. Realtors listing garbage disposals, washers, dryers, stoves, and even the kitchen sink when they know you're doing a 1031 exchange. It makes things really messy, especially when the items get listed or fixtures to begin with and they have to be assigned to some type of market value. So, in part 5, we will discuss proper documentation, escrow and time requirements. This is Russ Squire for 1031 Exchange. Thanks for listening.